Trading activity, as I mentioned, is not discretionary, and so on. The size and the direction of these flows depend on how much dealers' delta wanders around. And that in turn depends on changes in the underlying price, changes in the implied volatility, and changes in time. I see there's a mistake on this side, a typo. I have to change that. But just to give you an idea, when we are talking about all markets and the holistic market overview, what we want to use in our trading to make money is that we depend on these big players. And themselves, they rely or they depend on the changes in the underlying price, changes in implied volatility, and changes in time. So, and now we are coming to spot gamma. I don't know, I hope so, and I'm not sure, but some of you might not only trade options, but also are subscriber to at spot gamma with Brent. We are measuring these effects of these quantities, underlying prices, volatility, and time. We are measuring them with gamma, Warner, and charm. So spot gamma is giving every day a report, and he tells us where the gamma is, how the gamma is changing in delta with respect to the underlying price, how the volatility is changing, or Warner is changing in delta with respect to implied volatility, and the charm is the change in delta with respect to the passage of time. And that's the market maker is sitting around his long out of the money calls area where he is gamma long. And if the index rises, his option delta will increase towards 1 as options gets closer to the money. He will need to sell more of the SPS index in order to counter that. If the index falls, his options delta will decrease towards option 0 because the options get further out of the money. So that means he needs to buy back some of his S&P shorts in order to offset this price movement. In summary, if the dealers are long gamma or long gamma, that means they are buying the dips and selling the rallies, which acts as a kind of stabilizer in the market. If the long gamma exposure is significant, for example, a large open interest, it works as a magnet and pins the index around a certain price range. And when the dealers are long gamma, they provide liquidity by buying the dips and selling the rallies, and that reduces the index volatility. What I'm at this very short and brief overview about options. If you want to know more about options, please go to Cem Karsam, for example, or other great guys in the social media. I like Mr. Perfiliev, who is a great teacher in terms of options. Excuse me, and that will give you a little bit more insight how this option market regulates or influences that what we are trading in our markets. That's quite important. Because we are not, you see that this gamma exposures and this gamma levels here on spot gamma. You can have that for Bookmap, you can have them for a NinjaTrader. What I'm doing, I'm receiving the institutional levels who are also based on options. You see they're very close some days with this gamma levels here as well. And what I'm using, I'm using this institutional level just as some guidance through the market all the day. We will talk a little bit later tomorrow about the institutional levels very briefly and to show you what I'm doing here with this institutional levels. But you can subscribe to Spot Gamma in order to get the gamma levels. But what we can do actively, so we are totally we are totally dependent on the market of the gamma. We can't use this actively for our trading. we can't use spot gamma levels very active for our trading. I mean, the call wall might sit at 4700 SPX, that means 4696 in the ES, for weeks, and the market is not trading towards a call wall, for example, in this case. Or when we are triggering the volatility level here in the in spot gamma, then don't know where it is today. We can't rely, because these are levels which we can't influence. They are there, and we can hope that the market will trade against call wall. You see, they broke the call wall, and the levels I have where indicates a high of 47, 47.02, 47.05 here. Maybe the next one is 47.10. I'm not sure. I didn't report more levels than 47.10. By saying that, the question is, if you want to trade or if you understand, when you understand the options, then it will ease your life. But if you're not actively in the options business, then the spot gamma levels are inactive levels which might be traded today or maybe tomorrow or who knows when. We want to know, and that's the point where I want to go to. We want to know what is really helpful for our trading, and that's gamma, because they are static levels we have in the book, or we have on the chart. Gamma, which is the static part of the chart. If you are following spot gamma, or if you want to have my institutions level there for free. And the other point is the volatility. So you know gamma, Warner and Charm. Time is a little bit more complicated, and we will see some changes in the underlyings and as well in the trading when we are rushing or we are going towards the option expiration day on 16, 17 every month. That's the important days where all these options expires. The time is let all the deltas coming to zero, and that's the time where maybe the market is a little bit without orientation, because all these big market makers are at a certain moment out of the market. So the market trades, let me say, his own opinions and moods or whatever. That happens around the option expiration day. So we have, again, I repeat it, we have gamma as static levels, and we can observe options. We can observe volatility. And that's what we want to do today, in the next session, and we'll start tomorrow with the correlations of SPX, SPY, volatility index, VXS. I will show you the UVXY. I will talk a little bit briefly about the ADD and tick. And that will complete our picture as day trader. Maybe it sounds a little bit off, or maybe it's something new to you, but allow me to show you what I'm talking about, and then we'll put these both pictures, the macro view of the market and the micro view of the market, what we discussed, how to put this to a complete discretionary trading picture. So to repeat it, as liquidity deteriorates, the implied volatility moves higher, and as liquidity improves, the implied volatility falls. We are now gamma, we are now in the volatility part. And the great part, guys, ladies and gentlemen, please listen. And the great part of these volatility indexes and the SPYs and the QQQs for those who are trading NQ is that what we have discussed up to now is valid for every single instrument. I think you start to see the connections between where we started yesterday with the auction, with a dome, with a liquidity, and then volume spikes and sweeps. And then you start to see that this picture comes together when we're talking about the SPY. I have the SPY here on my chart. For those of you, I will go a little bit more in detail for every one of you, because that might be something new for everyone, but it doesn't matter. The principles, what we have discussed up to now, are same for every single instrument. They're a little bit different. The liquidity is different. The volume is different. Therefore, I'm insisting to watch the market volume for an instrument. It doesn't matter if you're trading CL or NQ, or the average liquidity and the average liquidity of the instrument. So this is the SPY. Given we are here at the beginning, this is the start of the session 9:30 a.m. Eastern Time, and we have this. It's not correct, but anyway, it doesn't matter. Now we have the market progressed until 10 o'clock in the SPY. What do we see at 470? I know it's late, guys, ladies and gentlemen, it's late, but come on, work with me. The next half an hour, we will go straight forward and we will go more in detail tomorrow, but try to work with me here. Come on.
Liquidity.
Yes.
Liquidity.
Okay, great.
Liquid.
Great. Liquidity.
Okay.
Look here. 12,449 are still sitting on 470. What is the SPY? And the first idea, the very first idea, when you watch SPY, you are saying, okay, there's 470, there's big liquidity there, 12,449, because now you can quantify the number, you see the number in the dome, because you have the dome on your chart, and that's the, yeah, what we have talked about. Now you start to see that 470 might be an interesting point. But the most logical point at when you see that, when you realize what we are talking about, is that the price might go towards this or trade towards this 470. And if the price trades towards 470, what does this mean? What does this mean for the yes?
Yeah, it goes with 4,000.
Yeah, it goes with 4,700. Right.
Buy is a tenth of the
Yes.
years. Huh?
Now for those, let's go step by step, because I want to have every one of you on board. The SPY, the Standard and Poor's Depository Receipt, or SPDR, 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 is a type of exchange-traded fund that began that began trading on the American Stock Exchange in 1993, when State Street Global Advisors Investment Management Group first issued shares of the SPDR 500 Trust, SPY. Sometimes called SPDRs. SPY is an ETF based on the SP 500 index, and each share represents an ownership interest in the 500 stocks in the SP 500. The value of each unit in any SPDR exchange-traded fund at any given time reflects the movement of the underlying index. Trading under the symbol SPY, the SPDR 500 Trust, for example, is designed to trade at approximately 1/10 of the level of the SP 500. All the links, if you want to know more, are in the documentation. See Investopedia if you want to dive more into this instrument and the following instruments. This is not my this is not my text. I'm just copied that from Investopedia, and it's a copyright on Investopedia here in this documentation. Excuse me, I saw Oh, what happened now? I saw a mistake here. I just have to. Okay. It's very clear. The SPY is the spider is the ETF. And the spider, the underlying of SPY is the SP 500. And when we see the same structure in the SPY, look here what happens here. How genius this is. Along the spider, we will talk about other instruments which totally completes our picture of the market. Then we saw this 470 at the beginning of the session. And then what we see here is here. What happens in 471? Yes, Alexander. Liquidity. Liquidity came up or was added at 12 or 1, what is this? 114, 115, it doesn't matter. But you see with one blink of your eye what the market is telling us. We have had some volume spikes which are exhaustions and need to trade back. They need time to find new buyers in this case. We saw a volume spike here in the SPY, and therefore that's the genius of TradeFinder, because you can use it on ETF, on stocks and so on as well, and it gives you meaningful information, important information about this market. And then you see the liquidity comes up at 471. So excuse me, go ahead. Was there a question? I'm not sure. Yes.
One question, Walter.
Chris, I look at more, not only on the SPY. Just give me a few minutes to explain everything. Tomorrow we will discuss about the whole process and what we are discussing here. It's not only the SPY. There are some more valuable information what really happens. So excuse me.
This is Euless again.
Euless, okay.
This is Euless again. So there's some liquidity also added around the 4701 area.
After the fact.
Like after the fact.
If you go down,
How do you interpret that?
47.
I'm sorry. I'm actually.
I'm actually talking about the ES.
Okay.
So
Okay. Just
we're
a moment. I have to switch back here. You mean 4701 here?
Right.
Yes,
Right.
it is added, but at the moment the price could go towards 4710 and 12 and as well 4701. There's no how I'm judging, how I'm seeing this it's an information. It's an maybe alert that the price can go up into 4710 where this institution level sits and then go back to 4701. At the moment, Euless, we don't know how the market will behave at this stage of the market. We recognize and we keep in mind 01 is a level and 10 is a level. Let me just draw the price alert. So these are the levels we are just working with. Based on the information here on the SPY, we have we're on the traction point at 471, and based on the yes, we have an attraction point at 4710 and 12 here, as well as 4701. It's really hard, Euless, to say whether the market is going straight away now down to the 01 or it's going back, finding new buyers, and they are trading at the end of the session, which is in 2 hours, 2 hours and 20 minutes. is trading then towards 47.10 or maybe even 12. I'm saying I'm judging that as, or I see that as simply information of the market, which wants to bracket the price around 01 and 10. This is the next level here, and I'm suggesting to go step by step to the order when you are long, given you are long here, because everything is screaming long at the moment here. Giving you a long, simply protect your position here. And that's all what we can do. I don't know we don't know at the moment where the price is going to trading into 10 or even 01. That's my interpretation of the market right now. Does SPY or AS give better signals for day trading VS, or is it perhaps best to use both? No. Give me some time to explain everything, and then we can discuss the whole concept, because it's genius. I tell you that. I strongly believe that. I wouldn't say that. Otherwise say that. That's the picture right now. We have the attraction point 471, although keep in mind, don't fall in love with all liquidity levels. They can be cancelled immediately. But as the price, as the time goes by and we are trading that, we see very nice signals on the SPY here, and we see a kind of attraction point at 471, which means is 400 is 47.10 here. Not sure if they are going to hit that right now, but anyway, the market is maybe in a break point at the moment. We have two extremes here, 10 and 01. That's the point. So I'm not sure. I wouldn't trade that because I don't see anything which is tradable at the moment in this stage of the market. There's nothing I see. Maybe if I'm risky, if I'm aggressive, I would like to go long. Yes, Argo, it's a balanced market. It's nothing special at the moment we have here. Maybe if you are really an aggressive trader, you can take the sweep and go long off the sweep here of 5 into 7 and 7.5 and fighting for 2 points here. That's a theoretical discussion right now. But just to give you an idea, first of all, when we trade ES, we are watching the SPY. Second, I didn't add that to the documentation. If you are trading if you are trading Nasdaq, if you are trading NQ, excuse me, then you have to watch the QQQ. You must do that. I'm saying really consciously, you must do that, because the QQQ is the SPY for the NQ. And please go into the Investopedia and read about the QQQ. I would suggest to go with a QQQ and NQ as well. But that's not the only one we are watching. Sometimes we will discuss some pictures I have prepared based on here on this my trading style. We have sometimes the SPY is building in divergence to the S&P. Sometimes the SPY is building in divergence to S&P. We will see that maybe not today but tomorrow. Okay, the SPY. Keep in mind the SPY, the spider, is the ETF. Excuse me. I've got a bookmap error here. Okay. The spider is the ETF, and it's trading the underlying index, and that's the S&P 500. Okay, I think that's easy to understand. If you have questions, please go ahead and
Walter, between SPY and ES, is is SPY, is SPY precedes. I mean, we saw the the liquidity on SPY, and we also saw the liquidity on ES. Can we assume SPY precedes?
No.
ES?
No.
Is it not the
no.
right assumption?
We don't, no. Based on that, what I've learned in this market is we don't have any advantages. We don't clear advantages that one index like the SPY or one ETF like the SPY is preceding ES. No, that's not the case. But what we can say is that we can find sorry? No. That we can find, just give me a second, excuse me, as well cut here. That we can find divergences, for example, or we can find anomalies where the ES is, where the SPY is trading lower than the ES. We will see that, and we will discuss that in maybe today or tomorrow. I don't know how long time you have here, but we see it's not that SPY is preceding S&P, and so we can say, okay, the SPY is rising, so the S&P must rise again as well. No, they are in sync, totally in sync, but we can see as I mentioned, for example, divergences. We can see how the SPY behaves based on the volatility. Give me a few minutes to explain everything, then you will see the whole picture. Coming to the wicks. As I mentioned, we have the gamma levels here, which are static. And we have the institution level to be based on gamma, on options levels, whatever it's behind. And now we have this the SPY. The SPY here. I don't know what this is here. We have the SPY, and then we can say, okay, the market is most probably trading higher. Good. Now, besides gamma, we have the volatility index. We have the volatility futures. We have the VXX. We have the UVXY. VXX is the ETF of the volatility index, and UVXY, I think, is the stock. Give me a little bit more time. Give me a few minutes to explain everything, and then we can discuss. So the VIX measures the short-term 30-day market volatility of the option prices of the SP 500 index, taken from a range of both call and put options. VIX levels above 30 generally tend to indicate high volatility. Those below 20 tend to indicate low volatility. VIX is just the price of every SPY option within 30 days of expiration. The VIX is interpreted as an indicator of the level of investor confidence or fear in the market, and therefore the level of investment risk, but it is commonly known as the uncertainty index. Okay, what we want to see is the VIX. This is the next friend of our trading chart we have to have a look at. I don't have a chart here in Bookmap of the VIX future, because it's trading extremely slowly. That's what I've got from the XFeed. So I'm not really happy with that, but we have alternatives. This is the VXX and this is the UVX. The VXX, excuse me. This is the VXX and the UVXY. First of all, the VXX. This is a volatility ETF. So we have the SPY, And now we are coming to the volatility in the market. Because that's the only point we can control the market when we look at the SPY and when we look at the volatility. The volatility ETF will typically move in the opposite direction to major stock market indexes, such as the SP 500 index of the Dow Jones Industrial Average. For example, when the S&P 500 is rising, volatility ETFs and ETNs like the iPath, week short-term future VXX, what is this called, will typically decline. On the other hand, when the SP 500 is falling, volatility ETFs and ETNs will usually rise. Now let's have a look at the VXX in Bookmap. I recommend to everyone to have the VXX in the Bookmap. Yes, as well in the Bookmap, because as well here, it's a little bit harder to read. Really, it is really a little bit harder to read in terms of liquidity. But what we can see is a clear decline of the VXX. Clear decline at the beginning. And as well, this market is not preceding the S&P market or the SPY, but it's in sync with all these markets. So the VXX is an inverse market, which indicates, okay, the fear is very low today. Therefore, we can say at the beginning, we should go long in the S&P if we are trading S&P, for example. Then we saw a quite nice, what is this? And maybe a volume spike here, not sure about that. And then it went sideways and then it goes against this liquidity. When the VXX traded here, as mentioned, the liquidity came up at 20 here. And we can then assume that he is going to trade towards this liquidity, which means, because it's an inverted market, if VXX declines, the market will rise. The S&P market will rise. The same functions applies to the VXX here. You see what happens right now. We have a little bit more upside from the low of the market. So from the low of the market here. So that means it is most likely that the market, the S&P, is maybe coming to a high of the day here. Not sure, but it can happen. It can happen. So we're very cautious with the longs here. If they can't break to this level. But let me see just a moment here. Yeah, so the fear indexes, that means the volatility is rising as well, the S&P is rising. We will see what happens next and how to use this information for our understanding of the SP market here, of the S&P mini market. You see it's rising, and then as well as S&P is rising, that's quite unusual. I would say that's a divergence. That's a divergence. The next one is the UVXY, and the UVXY is also called a stock, the volatility stock market or ETF, which is constructed to track the performance of an underlying index, such as the SP 500. The leveraged exchange traded funds ETFs with the highest 3 months level average daily volume are SQQ, TQQ, and UVXY. For those of you who are trying to trade or who are trading in NASDAQ, QQQ, SQQ, and TQQ should be mandatory to watch. I have not them on the chart here yet, and I haven't tested them, so I can't say anything or contribute anything meaningful to this ETFs here. These ETFs provide inverse leverage exposure to the NASDAQ 100 index, leverage exposure to the NASDAQ 100, and leverage exposure to the SP 500. That's important for us here. Exposure to the S&P 500 VIX short-term future index respectively. Let's have a look at a UV XY. From my point of view, that's the far better picture, and I like it the most, because I have quite good reliable signals. Additionally, to the SPY, to the SPX market, for the S&P a mini future, and as well for the VIX, because it is fast, it is highly traded. There's enough liquidity and volume in the UVXY to say, okay, the market, the only point we have to do here is we must go long. There's no how to say a discussion what to do here. When the market went up, when the market drops, I will show you another chart I'm using, and I'm using only two charts. One bookmap and one tick chart. When the market drops down, we have to buy ES. We have to buy ES. I'm sure this have been this sweeps we have seen in the book, but the market was strong bullish. Market was extreme strong bullish, and we have the same. Today it's a little bit more. It's a little bit more it's not so clear. On some days it's much clearer than on other days. But anyway, go back here and you see liquidity resting here on 1416, 1455 and 1450. So when we are following our liquidity logic, then at that point we have the information that the market will trade into this 1460 or 1465. In the meantime, we saw liquidity on 1515 here. That means the market went a little bit up here and then started again to drop down. That means we have a very bullish ES in this case.
Can you keep the side?
Can you keep the side by side?
Yes, of course. I will show you a better chart because it's a little bit much harder to watch that. So what's interesting here is the volatility starts to rise at 7 p.m. my time. That means, what is this? This is 1 p.m. 1 p.m. Eastern time. Started to rise here. That's quite unusual. That's really a little bit off. I would be very cautious with further long positions here. Although we have a supportive liquidity at 47.01, and now this liquidity is cancelled, and liquidity is added at 10 and 13, 12, 13 here in this area. But anyway, I'm very cautious with long positions here because I see the volatility is rising. And as well, ES is rising. That's totally unusual. Okay. And what I have added to my chart, and that was maybe this is really totally new to you. I would like to see the high yield corporate bond ETF. I was told that by my friends that the high yield corporate bond ETF is interesting to watch. It's an extreme slow ETF. Nothing proceeding, nothing going forward or foreshadowing anything. But it is an extreme, I value that, this HYG, high yield corporate bond, because the bond, HYG bond ETF seeks to track the investment results of an index composed of US dollar denominated high yield corporate bonds. One of the most widely used high yield bond. Exposure to a broad range of US high yield corporates bond. It shows. So it's extreme slow, and it's not proceeding as well as others. I'm not proceeding anything or anything here in the market, but we have the same let me just stretch that. I see I have to adjust it a little bit better. We have the same principles like we discussed yesterday and today. We have the same principles. We have support on the liquidity support here. We have synthetic icebergs. You see how big this high yield bond is. We have liquidity on this side, which acts as a resistance and acts as a resistance as well here. The interesting point with a high yield bond is that it starts to rise. It started to rise at 16 from what is this, 10:30 a.m. Eastern time, 10:30 Eastern time. And now what's totally interesting to watch, it started to drop at 12:30 around. Started to drop. This is not an inverse indicator. It goes in sync with the SP, with the other indices. Not totally in sync, but in sync. When it rises, you will see ES is rising or SPX is rising. When it falls, when it comes back, when it's traded back, then you will see by the time that the indices or SPX is falling as well. It's coming back as well. Totally interesting, maybe totally new to you, but it's really worth watching it and seeing what the market is doing here with the HYG as well. So, what can we control? What is under our control as day traders or maybe midterm traders? It is what we see on the book, in the order book. It is what we see on the chart. Here, live trading, liquidity, support, resistance, sweeps, maybe icebergs, adding, cancelling liquidity at different levels, fighting with the market. That's what we see on the book. That's real-time indicators. Nothing to guess or to argue about, because if liquidity is there, then liquidity is there. There's nothing to say about liquidity. But what we just should add to our arsenal of weapons, what we should have in our bag when we are trading, is that we should understand the underlying markets. We should understand the influence of the options, of the option market makers. And we have the spot gamma or institution levels on our chart, which gives us a kind of direction. And on the other side, what we have under control is not only gamma, because it's static. The only difference is if you are trading options, then it's not static. But for normal traders, day traders, gamma is static. But what we can vividly watch and look is the volatility. That means we have gamma, we have Warner, which we have volatility, and based on all these options, we have the VIX, or we have the SPY, we have the VIX, we have the VXX, we have the UVXY, and we have the high yield bond, which indicates, which help us to, which help us to determine the direction of the market. It's an additional important high yield influence of the market. You will see most of the time, if you want to follow this approach, because it costs you nothing, everything is there. You don't need anything to follow this trading approach. It's everything there. So we have in this case, I would say, we have a holistic market view. That's what I'm calling a holistic market view, because we have everything, let me say, under our, I don't know whether control is the right expression. I'm looking for another word. We have everything in our, I'm missing the right word right now. So we have everything under control. We can see that, we see the market, we see how the market behaves, we see the volatility, which is the WANA, we have the gamma on our chart, and we see as well as additional, we can add the high yield bond, which gives us a wonderful overview over the whole market. So therefore, we will stay with this market view. I will show you how you can apply this market view to your charts and how you can simply observe what the market is doing here. A comprehensive holistic market overview gives the smart trader an edge. It is an edge, and it's a real-time edge. It's a real-time edge. You don't need to spend money on really intensive additional indicators. Not necessarily not, but you can, of course. That's up to you. Trader will get the final confidence along with the discussed market signals about market direction, market divergences, and other market anomalies. There are a lot of them, or could be a lot of them. A complete market snapshot will allow to allow you to keep, execute, or to stay away from investments. That means, Jay, are you around? Jay is not around today. The most hardest point in our trading, is to be patient, guys. It's really, we need to be patient. If we are not patient, if we can't wait, and if we think we need whatever signal we want to have, a sweep or a stop run or volume spike or iceberg or whatever, they can give us an edge in trading. But we should understand what the market is doing as a comprehensive or holistic market view. And when we see the market is going long, then we should join the market in the long position, or to buy the market. We should buy the market. And we see there are divergences, which should be cautious. And if we are aggressive, we should take the opposite trade. That's the art of trading. We are warriors, and we as a warrior must understand how our opponent, how this market is going to trade, and we should then jump on this market. Let's have a look then here on this chart, and let's answer. I hope you are everyone is on board here. Let's answer the question of yesterday. Excuse me. Let's answer the question which came up yesterday. The question was, let me find a point where we started to discuss. I think it was here. That was the point. It was 5:34 my time, And we have had a discussion yesterday based on this. The question was raised, I don't know who, but it doesn't matter. Can we predict this move? Do we know what will happen next in the next 10 minutes? The answer is very clear. No, we can't do that. But can we predict the possible direction of the market when we are here? We mentioned, yes, there was an, what was it, iceberg or volume spike or stop run traded here into this area. Then we saw an liquidity here and we saw the liquidity here. So let's just move this around or move this away here. And that was the point here. And I mentioned tonight, or I woke up this night, and the answer was very clear to me what to trade here. I mean, it's hindsight, but anyway, it doesn't matter. Have a look on my chart here. That was roughly this area. You see my chart? Hopefully you see my chart here. This is the area we have had this discussion yesterday. Okay? 17 or 5:30 means 11:30 Eastern time. Okay? That was the stop run here, and the market went away, and then the market broke down very hard. The question came up, can we predict these moves? No, we can't. But we saw on Bookmap liquidity here and liquidity there. So for those of you, just repeat myself, this is the SPY. This is the WIX, 1 minute WIX here. Then I have the VXX expressed in ticks. The UVXY expressed in ticks, 300 ticks, and the HYG expressed in seconds, because it's extremely slow. That's the only reason why I'm using seconds here. Now, let me annotate this market. Do you see what happens in the underlyings of this market here? Can you see that? Algorithm, holistic view.
Go down.
Ah, interesting. HYG dropping. Tom, great. Great stuff. Excuse me, I missed your answer. I don't know who it was. Okay, that's the SPY. Yes, Karen, great, fantastic. That's the SPY here. Okay, that's the SPY. Myron, yes. Now I'm just putting the line here. I can stay in draw mode, yes. Give me a second. Okay, I have to switch that off. Do you see what happens?
Walter, if you extend
I think Walter, if you extend the top rectangle to the down, that'll be much easier.
I can't draw over. Okay, can't do that.
the one you already
No,
did.
the one you already did, not the new one. Yeah, you can hold that one and then
How can I
extend
do
it.
that?
You can click on it.
Yeah, you can click on it. Please.
Just
Just
a
click
moment.
no. Just click on the. Yeah.
But I can't extend it over the. These are separate charts, so I don't believe that. But let's do
Okay.
something else here. I think it was 35, 34. That was the time. So roughly when we are looking, let me have a look here on the book map. Where's book map? This is, what is this? 37, 38, 37. Here. Roughly, that's simply roughly what we saw, what we have discussed this question, whether we can predict this move or not. You see what that's not quite precise what I did here. Ah, come on. I must be more precise here with the drawings. But where I want to draw your attention is, okay, so that's the time, 35, here, roughly here. What do you see? It starts to rise at 45 my time, so that means 11:35. But you see very clearly what happens in the underlyings. When the market starts to drop here, it indicates something is wrong. You must be alerted. Just wait a moment with the answers, Myron. Add. Yes, as was making, but yes. As ES was making higher highs, but VXS do not make lower lows, but double bottom. It was not yearly. It wasn't even. My chartings, my lines are not really correct here, so apologize for that. Just make it a little bit more precise, just to give you an idea. So. The ES is trading, and the volatility is falling, coming down here. That means it might be a very pleasant up move. But suddenly, somewhere here around 11:15, whatever time, they started to rise silently, very silently. They started to rise.